usually a very strong time to be trading. One of the best times of the year. So we're going to game plan that. We're going to talk a little bit about options. I already recognize some of the faces here from the options class. Those of you who don't understand it, that's okay. I think just by going over this stuff, and I'm going to go over the swing setup as well, might give you a little bit of an understanding on what we are doing with options as well. All right, so let's get to it, and then we can get ready for one more trading day and then our Thanksgiving holiday. Um, let's start talking about seasonality. We were alluding to the fact that this is a very strong time of the year to be trading. Um, Thanksgiving week closes green 68% of the time, so almost 70%. And this is going back about 50 years. And the stats haven't really changed much over the last, say, 15 or 20 years. So if we look at the S&P 500 here and look at where Thanksgiving week started, that was right here. So this would be the close that we were leading into. Probably, again, going to close green. To have a pretty big dip here for this thing to not fit in that 68% win rate here. So it looks like we're going to have a winning week. So if you had some positions on, they should be doing very well through this period. So looks like Thanksgiving seasonality is going to play out. Now, November itself tends to be a very strong month as well. And November closes green about the same percentage. I think it's like 73 or 74% of the time. And we can see here, this is where November started and where we are right now. So we got a little work to do. I think December 1st, if I'm right, is next Monday. So we've got a little work to do to end up closing green on November. I would say November has kind of bucked the seasonality trend. And that's one thing to remember when we're talking about seasonality. Seasonality is not the be all end all. It's just another thing that gives us an edge, right? But these edges are 68%, 70%, 75%. When we look at small caps, 83%. So that means sometimes we're on the 29% side or the 32% side. So we have to factor in all of these other things. And even though we have strong seasonality in play for November, we've been taking a somewhat cautious approach, taking some trades here and there, but not going nuts and not getting super aggressive. And I think we should probably be that way until we get a good signal. And maybe today is that signal as we see S&P 500 up over the 50-day moving average. So that is Thanksgiving seasonality. Now let's talk about December. Another very strong month. December green 71% of the time. And that's factoring in the average of all three indexes. There is a December trend that usually plays out, and that is December tends to start slow, and then somewhere mid-month, we get the ramp up going into the end of the year, especially around what's called the Santa Claus effect. That's a few days before Christmas, and then a few days after, 2 days after the new year, the first two trading days. That tends to be one of the strongest, like week-long trading periods of the year. And again, I didn't put the stats here, but very strong stats, but not a given. But this is something to remember. So essentially, if there's ever a point you want to be aggressive, it's Thanksgiving to the end of the year. And then remember the way the trends play out within December as well. If we see a dip in December, which I don't know if we're going to see because we've already got the dip here in November. But if you see a dip in early December, that's often a good spot for pullback plays. So we'll obviously be watching for that. But we should be taking, at least right now, maybe a slightly bullish approach. And then obviously we'll adjust it according to what the charts tell us. And we've got a big Fed meeting in December as well that could throw all these numbers out the window if the Fed decides not to cut rates. So we'll see how that plays out as well. So that's kind of what we're looking at in terms of seasonality. Now let's look at, and let's actually skip to this as well. Actually, we'll as we go over our game plan, we'll hit this. Let's look at what the market is doing right now. So if we look at SPY, it was looking shaky, right? For a lot of November here, we can see where November started and is essentially had declined here down to 652 on SPY. But we've had a nice 3-day move back up over the 50-day moving average, which essentially gets us back in trend. All right. Uh, I agree. I agree, Karam. All right. So let's look at here. Even though we're back on trend, there is a little bit of a different change in character. And that is throughout starting with the April low, we've seen higher high after higher high and higher low after higher low. And that is the function of a strong trend. We get these pullbacks, but these pullbacks within the trend tend to be lighter, even if they feel a little strong as we're going through them. Do they make higher lows and higher highs? And essentially every one of these, you can see all my arrows here, have done that up until this one here in on October 30th. So right before Halloween. Now notice here, the next pivot high we had would essentially be a lower high here. We didn't get another higher high. It was a lower high, followed by a lower low. Now, this is only one of each right now. It's not really a trend yet, but it's something to be watching closely. When this thing, if this bounce plays out and we get another lower high, let's say we pivot right around here and then make a higher low to confirm that, that would be essentially saying the uptrend is over and we are in topish or downtrending kind of mode. So that's what we're watching for right now. Not a trend yet, but definitely a little bit more of a concern than we were through this period. And essentially, all of this is related to the December Fed. So the December Fed is going to really tell us what's going on here. Problem is that makes December trading a little hard and all this great seasonality that we have. But for now, we just follow the charts. What are the charts telling us? So I would say right now, slightly bullish. Normally, I would be very bullish during this period. We're going to say slightly bullish right now. And then if we look at the Qs, we see similar pattern, maybe a little weaker. And big tech has been a little weaker than some other areas. But notice here, this is what I really like when we're talking about market breadth. If we look at small and mid caps, which composes the Russell IWM, notice how strong this is. A stronger bounce than the other two. And today up 2%, back up over the 50-day moving average and closer to the all-time high here. This is a very good sign. So we've got some kind of mixed signals right now, and which makes us slightly bullish rather than say very bullish. But this is a good market breadth signal that small caps and mid caps are strong right now. If we look at T2108, this is stocks above their 40-day moving averages. Overall we'd like to see this a little stronger, but the bounce here has been strong in that. So a lot of this is telling us in this period right here, a lot of stocks are participating in this kind of 3-day bounce or recovery from that kind of November correction here. And we can also look at RSP, which is the equally weighted S&P 500, essentially making every stock the same value rather than the S&P 500, which weights the stock. So top 10 holdings make up about 35% of the S&P 500. And we can see here RSP very strong as well. So we're getting some good market breadth readings. I would say we're slightly bullish just because some of the momentum stocks aren't participating and some of the hot areas haven't been participating, and also because of the Fed coming up. But that being said, when we're slightly bullish, there are some areas that are very bullish. So let's go to the swing game plan right now. So tech and AI, we're essentially seeing two different setups playing out in like big tech and AI and software. Essentially, what we're seeing is either all of these stocks have been trending; they've been on strong trends, right? Or most of the stocks, and we're seeing one of two things right now: stocks that either are just right within their trends, their relative strength leaders, and have held up well during this period, maybe doing better than SPY and the Qs have. We see a number of stocks doing that. And then we see a lot of the momentum stocks have had deep pullbacks, kind of deeper corrections. And now we want to see how they bounce back. So essentially, we're seeing one of two setups: the regular kind of trend continuation setup, or we're seeing what I call rubber band setups, these deep pullbacks that are due or starting to kind of rubber band bounce. What happens with these rubber band bounces is you want to see how they react to the initial resistance level. So if there's a resistance level right here, do they falter at that level and continue down, or do they get back on trend? But in the meantime, we can trade these rubber band bounces. So that's what we're looking at in terms of setups related to tech and some of the hot areas like AI, quantum, uh, and nuclear energy. So we could pull up some of these big tech stocks, and we're going to see variations of that. Let's just pull them up right now. Let's start with the rubber bands. Here's Amazon, rubber band, right? Has been a very strong stock, but a very deep pullback to the 200-day moving average, and now we're getting the rubber band bounce. AMD, same thing, has been very strong, and now the rubber band bounce. Now let's look at example of relative strength. Compare that to Google. And it's interesting because these guys tend to move very closely together. But now we're seeing kind of a divergence or a split in some of these where we have these rubber bands, or we have something like Google, which is just on fire and probably too extended to enter right now. The market loved the update to Gemini here, and we see that big pop here in Google with the idea that Google is now kind of taking the lead in AI. Apple, same thing. We're seeing relative strength in Apple as well, not the deep pullback or the rubber band. This would be the relative strength that we're seeing right now. Both valid setups, but two very different setups. So that's what we're looking at going into the end of the year and how we'll trade these things, either standard continuation patterns on relative strength, maybe pullback plays or breaks of highs, or rubber band setups. Give me 1 second here, guys. Let's see here. I got to figure out how to delete people out of here, but I don't know how to do that. We'll just ignore them. All right. So tech and AI, industrials and retail. This is where historically we see strength going into the end of the year. And we're seeing that now. And we're seeing relative strength in these areas. So if we pull up XLI, we can see here, look at the big run up. And notice here, while it's not a really strong move now, while a lot of these areas have been pulling back hard, we've seen consolidation in industrial. So definitely an area we should be paying attention to. And retail tends to do well going into the end of the year. Makes sense with the holiday season. And we can see here over the last 3 days, very strong move here in retail as well. So a number of stocks we're watching here in terms of retail. We'll go through a few of these here. Let's skip the big box stores and go to the area that I really like right now, which is apparel. So we'll start with Urban and ANF, which had earnings today. If you look at Urban, had been a relative strength leader, had a deep pullback, and we've got a 10% move here in on earnings. A little extended to enter today. What we said in the swing chat today is we'll be either looking for some consolidation here after this big move or an inside day tomorrow. Now, not as nice of a pattern, but if we look at ANF, if we see this thing, we see the whole entire kind of market cycle here, where we have the big run up, the topping pattern, the downtrend, and now potentially a bottoming formation. We're starting to see some accumulation, and then the earnings breakout today. So this could be the catalyst now for the next kind of uptrend in ANF. Retail stocks are picking up. AEO, a similar company here. Again, not the best overall pattern, but maybe a bottom here, and then we've had strength over the last month and a half here in ANF, Gap, and ZUMZ, similar stocks as well, and we're seeing strength here, and then ZUMZ, same thing, and this has been a really nice trend here. So we're watching retail very close. Some of these discount stores are doing really well as well with the weakness in consumer right now. You can see how strong TJX has been. And then industrials. I've just got three of them up here right now: Caterpillar, 3M, and HWM, which is a defense stock. Good patterns here. If you look at Caterpillar, notice here, Caterpillar is not generally a stock that moves like a momentum stock, but look at this guy. Heavy float, but has been moving like a tech stock here. Made a high here on earnings and has been pulling back, but held the gap, held the 50-day moving average, and has remounted the 9. So I really like Caterpillar here going into the end of the year. 3M showing relative strength as well, and an HWM, a defense stock. If we pull this thing out, you can see the nice trend here, and maybe even a potential entry where it is right now after the hammer at the 50-day moving average. All right. Now let's go to small caps. So we talked about small caps being leaders going into the end of the year. We talked about these statistics here where we have around a 70% win rate going back to the last 50 years. Small caps, 83%. So we tend to see a lot of strength in small caps. There's different theories on why, but we do see the outsized edge in small caps. A number of ways to trade small caps. You can pick small cap stock you like, but you're kind of hitching yourself to one stock. You can pick ETFs that are heavy in small caps. So you can go with IWM. And for leverage, you could trade something like TNA, which is the leveraged ETF. Or you could pick some other ETFs in maybe a certain industry that have more small caps. So for example, IPO ETF, which is beaten down, but showing some strength here. ARC also is starting to show strength and maybe a rubber band bounce. So number of ways to play it. The other thing you can do is take the yearly leaders. What tends to happen is you get the funds and um, they're beholden to their clients and they want to show their clients that they're in these stocks that have been leaders. So even if they weren't in a certain stock as a year leader, you'll see these markups going into the end of the year. So I make a list right around December. We do this in the Swing Report every year where we've got a list of yearly leaders and look to trade those. And that'll give you an edge as well. If we pull up IWM, an easy way to do this for mid caps and small caps, you can pull up IWM, which is 2,000 stocks. So you get a big list of stocks and just sort them as year-to-date leaders around the end of November. So we'll do that right now. We'll just take the leaders over the year-to-date, sort them here, and we can see number one in IWM is KOD. And then just look at the chart patterns. Good chart pattern here. We could put that on our list. BE is another one. This is related to nuclear energy. Has been a leader, pulled back with the rest of the industry here. And now we're looking for, if we were to remount the 50-day moving average, really good stock to potentially trade going into the end of the year. So easy way to do it. Take your lists and just take the yearly leaders. Again, you can trade one of the ETFs as well. Biotech also tends to do well going into biotech and healthcare tends to do well going into the end of the year. Easy way to play that is the indexes here. Here's XBI, and we can see already how strong XBI is right now. I wouldn't probably enter this right now, but wait for a pullback. So early December, we talked about historically, there tends to be a pullback. If you see that in biotech, you could trade XBI or the leveraged ETF LABU. So we have tech, obviously, with rubber band setups or relative strength stocks. We have industrials and retail. We're watching very closely going into the end of the year, and then small caps. Regardless of industry, stocks that have been leading or just trading the ETFs. All right. So that's what I wanted to go over in terms of stocks. It's really easy to kind of narrow down your watch list for the stocks you're looking to trade going into the end of the year. We have an option strategy we're going to go over really quick. Before that, we have Black Friday deals going on here at Bulls on Wall Street. You can go to this link here, and it's also posted all over the place. And I think you guys have it in your email as well. Just about everything is on sale here. And if you want the swing deal here, it's only $397. Usually it's around $1,000 for the year. So good deal here if you wanted to join the swing service. All right, let's go to the option strategy we're going to talk about here. First, we'll start off with the swing. So those of you guys who are just swing traders, we can look at the swing. We talked about potential rubber band setups. A few of the big techs are putting those setups in right now, potentially. So Microsoft is one. If we look at the Microsoft chart here, you can see what I look for rubber bands is a stock that has been a strong stock that is beaten down recently. So obviously, Microsoft fits the bill. Going back to 2023, it has been one of the leaders here. Made a high here recently at 555 and has pulled back with some of the AI heavy stocks. And you can see here testing the 200-day moving average. Maybe this is our rubber band entry right here. So let's say we're thinking of this as a potential rubber band setup now. So we're looking at Microsoft. We like it as a potential rubber band setup. Of course, we could enter this thing here. Let's say we wanted 100 shares of this at 476. That would be pricey, right? 476. That's going to be about $47,600 position size to enter this thing. So not everyone can do that. And even if you can do that, maybe you don't want to put that much into that position size, right? Even if you have a $100,000 account, $200,000 account, you can only take like 4 positions of this. So we can use an option strategy that is still going to be profitable, but will cut down our potential costs for this. Now, there's a number of strategies we can use. Generally, I don't, what most people do is buy calls. I don't like to straight buy a call because the win rate is so low. So if we look at Microsoft here, we can see here if we bought it at the money right now. Let me go to the calls. If we buy it at the money right now, 475, it's trading about 476, so this would be at the money. Notice here, your break even is at 491, meaning, and notice the cost here as well. First of all, $47,000 for 100 shares. To control 100 shares, it's only going to cost us $1,600 here. So pretty good, right? In terms of leverage, we can get this very cheap. Even if we have a $10,000 account, we could do like five or six of these, right? So really good in terms of our overall cost and leverage. Now that's a positive and option. Whatever benefit you get, there's always a disadvantage. The disadvantage here is time. Notice here your profitability as time goes by, right? And in this case, if we're entering at the money, our break even here is 491, meaning the stock has to go up to 491 for us to start making money. That's why when you buy calls, you generally have low win rates because you have the time factor or the break even that you have to get up over. So when you buy a call, it has to be the right situation. One of the situations, so I don't do a lot of just straight buying calls. We use vertical spreads and some other strategies that are will lower the break evens for us. But one spot where I do buy the calls is when we have the rubber band setups, because we talked about how time is a factor, right? And we really don't, even if we're bullish on a stock, we don't know when it's going to make its move. Well, the theory behind the rubber band setup is it's really beaten down and it's going to spring very quickly, right? So because of that, my expectation is it's going to either move quick or I can get out of it, right? So if I'm looking at Microsoft here as a potential play, I know I'm not holding it all the way to expiration. I expect that bounce to come quickly, so I don't have to worry about that 491. My expectation is maybe it's going to happen by the 5th of December or the 8th of December or earlier than that. So my break even is much lower. So now when it hits 492, I start making money, where here I don't make anything if I keep holding it. So you need that catalyst when you're just buying calls. So this is a spot with the rubber band setup where we can actually buy calls and it can be profitable for us. And we can even do it more cheaply. It's one of the very few spots where I'll go out of the money. When you go out of the money, you are using a higher strike, which is creating a higher break even for you. So it's even harder to win, but it's getting cheaper. Notice here, when I have my call at 470, it's 1970. And as my strikes go higher, it gets cheaper. That's the benefit, right? It keeps getting cheaper and cheaper. If it gets to 500 here, it's only costing me $565. There's a reason for that. You're probably not going to win. So they make it really cheap, right? Look how high your break even here is, $505. So now Microsoft has to go up to 505 for me to potentially make anything. So maybe that's a little high here, but I can take it out of the money call. Maybe if I'm looking at this and I think it can bounce to 515, maybe I go out of the money to like 486 and make that even cheaper for myself. So instead of at the 470 where it's going to cost me 1970, maybe I use the 485 out of the money here. Now it's only costing me 1100 and it gets cheaper. My break even increases a little bit, but it got cheaper for me to play. So we can go either at the money or out of the money on these things, and this still can be very profitable for us as long as we don't keep holding on this thing. What I do with these things is I'll enter here. If the bounce doesn't happen in a few days, I just cut out of it very quickly and just take a very small loss or a very small win. So that's the strategy behind the rubber band setup and buying either at the money or out of the money calls. And then we could also do a vertical spread, maybe not with this strategy because we do expect a lot of profitability. What happens with the vertical spreads is you're pitting a buy and a sell against each other. It gets cheaper and your break even lower. So the problem with buying the call is you have a very high break even, right? So what we can do now is, for those of you who know options here, we can buy a call spread. And the way they've constructed it here, notice here, they're buying it at 475 at the money, and then they're selling it at 500. They're making essentially 500 the ceiling. Now, notice by doing that, the break even is lowering now. Instead of when we went out the money, the break even was like at 500. Now it's at 485, and we can lower that as well, depending on how we construct the spread. So with Microsoft, we could lower the break even here and get our win rate higher. It affects our profitability a little bit. Maybe we can't make as much, but it's worth doing because one, it caps our risk as well, and two, it gives us a lower break even where we start winning more quickly. All right, so a little introduction to options for those of you guys who don't understand options. If you're just trading the equities, remember rubber band setups and pullbacks are kind of the play in big tech and tech right now. All right, guys, so that's what I wanted to go over today. Remember, Black Friday deal. I think Kunal posted the link in the chat there. You can go, if you're on the email list, you'll get it there as well. And a lot of trading going on towards the end of the year. All right, guys, talk soon. Everybody have a great Thanksgiving.